Hey there, my name is Adam Winnig, and in this quick video, we're going to be talking about 7 Forex trading tips that will instantly improve anyone's Forex trading results. I don't care if you're brand new to trading or if you've been trading a while or if you're just looking for your edge and finally looking to have your breakthrough with your Forex trading. I guarantee you this video is going to give you a lot of huge epiphanies that will instantly improve your Forex trading results. Hey everyone, Adam again, and in this video, we're going to be talking about 7 Forex trading tips to instantly improve your Forex trading results. And again, this will be different than most of the stuff that you're being taught on YouTube. It's different than most of the retail or what we call the herd trading advice. Now, if you are interested in improving your Forex trading, we come out with videos all the time on this channel to help make your trading easy, lucrative, and fun. If you'd like to make your trading easier, more lucrative, and more fun, then like this video so you get notified next time we have a new video come out and subscribe to our channel. Okay, so let's go ahead and let's dive into this right now. 7 tips to instantly improve your Forex trading results. Okay, the first thing, number 7. Okay, we'll go from number 7 all the way down to number 1. Number 7 is to not use overbought and oversold indicators. Hello, this is totally different than what most people do. Most people teach some sort of strategy where you can just set it up and use an RSI or something like a stochastic indicator. And the big problem with these overbought and oversold indicators is that you're constantly trying to catch the tops and trying to catch the bottoms of the market, which means inherently you're likely trading against the trend, which is one of the biggest pitfalls among retail traders. And on top of that, the smart money or the banks and the market makers, they understand that everyone's looking at these indicators. So that's why so often you see that these overbought, oversold indicators don't really do anything to tell us about future price. Overbought, oversold indicators is simply telling us what's happened. It's a lagging indicator that kind of tells us what's happened in the past. So if you'll just stop, I know you may be thinking, well, how can I stop using this? My whole strategy. Well, if you'd stop using the overbought and oversold indicators, you're going to have a lot more success. And I'll tell you what to do instead. Okay. Number 6 is to simply trade with the trend, okay? Trading with the trend, you've probably heard this a million times. The trend is your friend. Why don't people do it? Why don't people do it? And I can give you proof that vast majority of Forex traders don't do it. Well, I don't know. Maybe it's because it's hard to tell. Is there a trend or whatnot? So we've made it really simple. I use this little tool called the Bank Secret Indicator. I'll put a link in the description so you can try it for free for 7 days and only pay for it if you really like it. But basically, this makes it really easy to see the time frames and to see what's happening. If it's blue on these bars, it means that it's an uptrend. If it's red, it means that it's a downtrend. So for example, if I'm trading the H1 time frame, then I'm likely going to make sure that the time frame above it is at least in the same direction. So I'm trading with the trend on both the H1 and the H4. And ideally, if it's also in the daily, then that's even a bonus, right? I can see that the H1, H4, and daily, they're all in an uptrend, which means that I'm only going to be looking for buy positions. If you're looking for sell positions, you're shooting yourself in the foot. So don't do that. You want to trade with the trend. Absolutely. The trend is your friend. This indicator makes it really, really easy to see that. Number 5 tip is to trade the H1 time frame or above. Why do I tell you to do this? Because this is what the smart money does. The retail traders, or what's called the herd or the uninformed, they like to trade the lower time frames. Like they'll try to use the M1 or M5 or M15 but look, the reality is if you're trading these time frames, like it's stressful, it's hectic, your emotions get involved too much in these lower time frames. You make emotional decisions. And on top of that, it's cloudy, it's muddy. The zones are not really solid there on those lower time frames as they are in the higher time frames like the H1, H4, and the daily. I have a friend of mine that was a professional Forex bank trader for many years. He says that the banks, they really only look at the H4 and the daily time frame. This is where the smart money looks. So if you want to be like the smart money and unlike the 95% of the herd that loses money all the time, then only trade the H1 time frame or above. Number 4 is to use at least a 1-to-1 risk to reward ratio. This is a huge flaw among so many Forex traders, is they're using skewed risk to reward ratios. Now, let me break this down for you with actual real data. Now, here's the problem. You can see that this data was pulled in from over 43 million trades that pulled in from different retail Forex traders. And you can see that on the Euro US dollar here, you can actually see that the herd was able to predict a winning trade trade 61% of the time, which is great. I mean, so how, if people are able to predict winning trades the majority of the time, how come they're not actually profitable? We know that the herd is 95% unprofitable or net losers. If they predict it more than half the time, how come they're actual losers? And the answer is because the losses were 70% bigger than their wins. The average losing trade was 83 pips and the average winning trade was 48 pips in this 43 million trade simulation. That was actual trades that came in from retail traders. And you can see here, this is the average loser versus the average winner. And you can see that the risk to reward ratio is all backwards, like really, really poorly backwards. Now, simply just using a 1-to-1 risk to reward ratio has major advantages. If you look at this graph right here, you can see people that used at least a 1-to-1 risk to reward ratio versus people that did not. And according to this data, it shows that 53% of all accounts that operated at least a 1-to-1 risk to reward ratio turned a net profit in this 12-month sample period. And those who operated under a 1-to-1 risk to reward ratio, a mere 17% of those accounts were profitable. So look at this. Simply by using a 1-to-1 risk to reward ratio, you'll increase your odds drastically. You're 3 times more likely to be a profitable Forex trader if you simply use a 1-to-1 risk to reward ratio. Number 3 is to trade Contra crowd. Now, what does that mean? Well, the market's made up of 2 different players, right? There's the smart money, which is the banks, this is the institutional traders, this is the hedge funds, this is the smart money, the people that are winning the majority of the time. And then the other side, there's what's called the herd or retail traders. And as we know, 95% of the herd are actual net losers. So here's an interesting concept. If we know that the herd is almost always net losers, why not just do the exact opposite what the herd's doing? And if you just did the opposite and you know that they lose 95% of the time, the chances are you're actually going to be able to win simply by trading against what the herd does. So I like to use this bank secret indicator like I showed you. You can use it from MyFX book. I think they have a tool as well where it pulls in the market sentiment, okay? And this is what I like to see here. So this is basically pulling in data from hundreds of thousands of retail traders from MyFX book, from different brokers, and it's calculating so you can see what the herd is doing. So in this scenario, you can see that the herd is 88% short and 12% long. Now, if we know that the herd is vastly wrong the vast majority of the times, then wouldn't it make sense that we'd only want to look for buy positions? Well, yes, absolutely. That totally makes sense. And you can pull this up on any time frame and you can see what the herd is doing. In this scenario, you can see that the herd is short, right? You can see that the herd is short 80% versus long 20%, okay? And it doesn't really make sense considering if you look at all the blue bars here, I mean, it's pretty much in an uptrend on everything besides the monthly. So why would they be short? Doesn't make any sense. And I'm going to talk about this in the number 1 tip, so make sure that you stay tuned. But this is number 3, is to simply trade Contra crowd or against what the herd is doing, because automatically you're going to align yourself with the smart money. Number 2 is to trade with small losses but big wins, okay? And this kind of goes into the same thing that we're talking about earlier about using a favorable risk to reward ratio. But the big problem is that people, they will accentuate their fat tail risk, but they'll cut off their fast tail reward. So let me show you a graph to actually show you what I'm talking about. Okay, so this little depiction here shows what actually happens. Most people think that their trading falls into a normal bell-shaped curve. Statistics, go back to statistic class, basically anything falls in a bell-shaped curve. If you look at babies' heights, the vast majority of heights will fall in within 1 to 2 standard deviations away from what the median is here, right? If you look at incomes, it's the same thing. Pretty much everything in life follows a normal bell-shaped curve, but in the market, trading does not. There's what's called fat tails, where this is the chance of you like having a big fat tail reward in your favor. And this is the chance of you having a big fat tail loss against your favor. And you can see this red line is what the market actually looks like. These huge fat tails do exist and people tend to ignore this. So the problem is that people, when they're trading, they'll allow these fat tail risks to be there, but they'll cut off their fat tail rewards. You've ever heard the, people talking about you can never go broke taking a profit. And the answer is, yeah, you actually could go broke taking a profit if you have a poor risk to reward ratio and you don't let your fat tail winners ride out, but you let your fat tail losers drag on. And an easy way to do this, if you use any sort of martingale or cost averaging system where you're continuing to stack on losing positions when a trade is going against you, then you're opening up this ability to lose fat, like to lose the, have these big losses, bigger than normal losses. And also, if you're using a martingale or cost averaging system, usually you're just trying to get a little bit of profit, right? Or you're just scalping a little bit of profit. And again, if you have these small take profits and these large stop losses, this is just a recipe for blow up. It's going to happen. And again, why is that so? Because you're limiting the fat tail rewards and you are allowing yourself to have access to the fat tail losses, the extreme losses that can happen. So again, the key here is to keep your losses small and to make your wins big. And how can you do that? Well, one of the best ways that you can possibly do that is by trading with the trend, having a favorable risk to reward ratio, and actually using trailing stop losses. If you use a trailing stop loss, this allows you to trail. And if the market really goes in your favor on these big trends, which happens, as you can tell with these fat tails, then it allows you to capture the big fat tail reward end of the spectrum. And the number one tip is to simply do not try to catch tops and bottoms. And it's so aggravating because this is what the vast majority of people teach is they just teach you, okay, to buy low and to sell high, right? We've been taught that our whole life. It's been ingrained in our whole life. But the problem is we don't know how low the lows are going to be and how high the highs are going to be. So trying to time it can be disastrous for your Forex trading. And I'll just pull this up to show you a quick example. If you look at the AUD USD chart here, you can simply see that this isn't an uptrend. It's a very clear uptrend on the M1, M5, M15, M30, H1, 4-hour, daily, weekly. It's all in an uptrend. But what is the herd trying to do? As you can tell, the herd is 80% short. What does that mean? The herd is think that the market has overextended and the market is overbought. So they're trying to sell. As you can see, their short positions, 80% here. The vast majority of them are trying to sell. And this is why the herd gets hammered in these sort of situations. When these trends occur, they keep trying to catch the top, keep trying to catch the top, keep trying to catch the top until eventually they blow their account or they have, a huge loss that they incur. So simply not trying to catch the tops and the bottoms is an amazing idea because it keeps you trading with the trend. It allows you to have favorable risk to reward ratio. And it's just something that's automatically going to align you with the smart money. Okay. So these are 7 tips to instantly improve your Forex trading results. And again, if you like this video, then go ahead and consider subscribing and watching some of our other videos. Also, if you wanted to get access to the bank security indicator that I showed you here, you can get it for free. I'll include a link in the description below so you can get that out and check that out for free and only pay for it if you like it. And also at the same time, when you do sign up, we're actually going to give you access to our favorite trading algorithms as well as a bonus. So go ahead and do that now, take action, and we can't wait to see you on the next video.